Joining us now is Bloomberg's Dani and Oliver Haarmann, the founding partner of Searchlight Capital Partners. It's a private capital and debt shop with about $12 billion under management. Dani.
Tom, thank you very much. Those are a great way to set us up. I mean, Oliver, some harsh words from Mark Rowan over at Apollo. Do you agree with him? Is this the end of an era for private equity?
Well, look, first of all, it's an end of an era for a lot of things, right? I mean, we've been through some of the craziest times you can imagine as an investor, as a human over the last 5 years, given the pandemic, the subsequent Russian invasion of Ukraine, the energy crisis that fell from that, the cost of living crisis. And then on top of that, we emerged from all of that. The climate volatility has gotten crazier. People are now looking at AI and how that's disrupting lots of industries. So it's an end of an era and a new era for many, many parts of the economy, and constantly challenging you to think in new ways, which is interesting.
I also think just Searchlight's history is interesting in this study because you started it about 14 years ago. It really was the start of this boom cycle for private equity.
Yes.
If I could say, Oliver, would you do the same today? Would you start Searchlight today, would you?
Absolutely. Yeah, absolutely. I think we had a great platform. One of my co-founders was at Apollo for a long time, worked closely with Mark. I was obviously at KKR. The third co-founder was in Ontario Teachers' Pensions. So we've got a great platform. We built an international business across Europe and North America. And we've been able to stay flexible and find really interesting opportunities that are out of the common, ordinary way of looking at things.
So what do you have to do different in this environment? I know you have a hybrid capital approach. What do you have to do differently in this environment with the changes you were just laying out?
Well, you have to be innovative. You have to stop thinking on conventional themes. I think Mark was probably hitting on some of the points around higher interest rates. Obviously higher interest rates impact all businesses, especially if you're valuing a company, because if you're valuing a company, often you're going to look at the future value. If it's cash flow, you might be discounting them back to the present. You'll be using a higher cost of capital just as a function of higher interest rates, which puts downward pressure on valuations. So as an investor, you have even more focus on finding businesses that have fundamental, attractive growth attached to them, and also that you think you can buy at an attractive risk-reward in this environment.
One of the things that also impacts, though, are the many companies that are going to come up for refinancing next year that are going to hit maturity walls.
Yes.
What does that mean for you as a fund?
Well, obviously, maturity walls have a lot to do with debt is coming due. It's a term that people use. The debt's coming due, and what does a company do at that point? Either it pays off its debt. That's hard to do. Sometimes you're not going to have that massive pile of cash sitting on your balance sheet. So often you have to refinance. That's classically what happens. It's what governments do too with their treasuries or guilds. And that gets harder to do if interest rates are higher, because by definition, the cost of refinancing it is going to be higher than what you're currently paying, which means your earnings are probably going to come down. And the only way to prevent that is to actually do other things, either drive more growth that can make up for that earnings shortfall, or to cut costs. So I think it's going to put a lot of pressure on companies. It presents opportunities for funds like us to help them potentially with additional capital to find those growth strategies, which will allow them to refinance the debt and continue to grow into the future, to offer great services, great products, and employ lots of interesting and talented people.
So what does that look like? So are you looking for those sort of bolt-on acquisitions? Is that what it is? Are you cutting costs across all of your companies now to cope with that?
Well, look, what it fundamentally means is that you have to be creative in creating value. We have definitely been very aggressive in some instances buying companies for our businesses. Often when in tough times like this, you can often buy a competitive business at maybe a lower price than you would have in the past. That allows the companies that we own to take those businesses, integrate the best products and services, build a larger platform, create safer jobs for everyone in the total company. Of course, we have to have some efficiencies through cost synergies, but mainly they're growth-driven. Also repositioning those companies into higher growth sectors.
That's also interesting you're finding good deals there, because I thought part of the conversation is that valuations actually didn't come down that much in the COVID back. So you are actually finding cheap
Well, I
things
think
out there.
valuation is one of those things. People look at the market indices, right? And they talk, valuations are this way and that way. And of course, the market indices right now have been up. A lot of it has been driven by, as we know, big name firms, a lot of it driven by tech, a lot of AI stories and a lot of AI hype in some instances, and a lot of AI reality. We found that there's real opportunity in public equities, often in the smaller to mid-cap stocks that are often ignored by banks and equity research analysts, that often don't pull in a huge base of retail investors. And those shares are often a lot cheaper than they have been historically and much more attractive to acquire as a result of that.
Yeah, I mean, Gresham House, last month, you announced that you were going to take that one private. It is take private specifically in the UK, too, because this isn't the only one you've done recently. Is that the opportunity set right now?
Well, we've been very active in public to privates as a firm. So we've done public to privates probably in more jurisdictions than just about any other firm. We've done it in the US, Canada, Sweden, UK. We think often we can find really interesting and attractive businesses that are ignored, undervalued by the public markets. We feel we can come with a vision because we can sit down with management, look at a 5-year plan, look at 5 years of, hey, what can we do with this business to grow it, to make it better and more profitable, and also offer better products and services to customers. And that allows management to focus on medium-term success, not just every quarter. What am I going to do quarter by quarter? What am I going to have to announce? That can often drain energy, can lead to short-term decision-making and not as much strategic thinking. So often we can actually come to these businesses with a longer-term plan that makes a lot of sense, that they're excited to get behind.
And I get that, especially with an asset manager who would say, why would you judge us quarter by quarter when our own investors are in these funds for the long term?
Yeah. Obviously, that company hasn't closed yet. You know, we have a board-recommended bid that's been announced and is going to a shareholder vote at the end of August. But fundamentally, yes, that's also a business that's focused on green energy and sustainability, which also is a long-term growth sector. And Hive, was a really, really attractive business in a sector that we really know, global events. And on the back of that, we think there's a lot we can do because it's positioned in growth industries. And if we've learned one thing coming out of COVID, people love to connect. People love to go to conferences, see their colleagues. It's also super efficient. You're at a conference, you can see your colleagues from all around the world, competitors, customers, suppliers. You don't have to do a lot of travel. It's also more economically and efficient, also ecologically more efficient in many ways.
And it means you can join us live here on the Bloomberg TV set. Oliver, we're going to have to wrap it up.
Easy to do, yes.
Thank you so much for joining. Really appreciate your time. And Tom, yes, that was Oliver Haarmann, the founding partner.
Really interesting in terms of the fundraising environment, in terms of valuations, in terms of the opportunities around moving from public to private as well. Oliver, thank you very much indeed. And of course, Dani Berger for bringing us that fantastic interview, those insights into the world of PE.